stuff. Yeah. So, all right, I'm gonna get started here. I'm gonna mute everybody. So, all right. Okay, can everybody hear me? Great, awesome. All right, I want to thank everybody for joining us today. I know it's crazy to think that in a time where we can't leave our houses, we would actually be so incredibly busy. So thanks so much for making the time to be here. Really appreciate it. A couple of housekeeping items. There is a mute button at the bottom of your screen. I have everybody muted right now, but if you see that you're not muted or you're asking a question or involving, make sure you mute yourself back again, just because all of a sudden your life will come into our lives. Not that we don't want that, but it'll just be a little distracting. And then there's also a chat feature at the bottom of the screen towards the right side. You'll see a little bubble, like a cartoon bubble. If you click that, you can ask questions. If you want some anonymity, I would ask the questions to Lauren Lee. Lauren, can you say hi?
Hi, everyone.
Hi, Lauren. Lauren's our administrative assistant, and there's a little drop down in the chat area where you can click it. You can select Lauren Lee. You can ask her a question, or you can just send the question to the group. Lauren's monitoring the chat, and then later on in the talk, we will go back through the questions. If we're missing anything or you want further clarity on anything, we will do that. Also, the call is being recorded. So if you have any outstanding warrants or you are supposed to be someplace else doing something else, I would probably lay low on the call. Okay? All right. So once again, thanks you guys so much for being here. For those of you who may not know me, I'm Richard Wilkinson. I'm a real estate agent with Compass. I'm also the CEO and team leader of the Wilkinson Properties Group. And I live here on the east side of Los Angeles with my wife and Jennifer and our 3 amazing kids. For those of you who do not know this, I turned 47 on April 4th. So it was my first birthday in quarantine, or safer at home, which was a very unique experience, something I haven't experienced before, obviously. But it was actually quite wonderful. I had the opportunity to spend a lot of time just reflecting, and spending time with myself. And I realized a couple of things. Many of the decisions I made in my life, the things that have driven my life, have been about a few specific things. Connecting with people, trying to bring people some joy, share some laughs, and try to let people know that I really care about them. And also to try to essentially just make people's lives better from being with them. And so that was really the impetus of creating Real Talk, was to build upon those things, create connection, hopefully bring you some joy, hopefully bring you some good information, and just make your lives and my life a little better from being with you. So with that being said, we're going to get started. We're going to talk mortgages. So today our special guest is Daniel Arias. He is the founder and the team leader of WeFundLA. They have offices in Pasadena and in Highland Park. He is a senior mortgage banker in the industry for over 16 years. Daniel is also an active member of the LA Sheriff County's Reserve Force Bureau. He's a pilot. He can fly a plane. So if this all gets really crazy, we can go to Daniel's house and we're out of here. So, and also, most importantly, Daniel is a member of the National Association of Mortgage Lenders, and Daniel has won their annual Christian Slater lookalike contest 3 years in a row. So, Daniel, say hello.
Hey, Richard. Hi, everybody. Thank you for having me on today. Happy to be with you guys and give you guys a quick update on what's going on in the mortgage world. It's not very exciting stuff, but I think it's very important stuff. So thank you for having me on today.
Thanks, man. So Daniel, can you just kind of give us like a quick sort of overview, a recap, a 30,000 foot view of like what sort of you're seeing?
Yeah, so there's a ton of change in mortgage industry, and I think there were a couple of things happening simultaneously that have kind of created this perfect storm, right? We had rates come down to the lowest levels ever recorded, right? Like for 3 days in early March, on March 3rd, 4th, and 5th. I'll never forget those 3 days as long as I'm alive. Those 3 days, rates went on sale. We were giving away money at like, close to 3% on a 30-year fixed. And so you can imagine there was this wave, this tsunami of applications that hit the industry, right? To give you some numbers, some statistics, what we normally take in a 6-month period, we took in a 3-day period, right? In about a 6-month period, we take in about $1 trillion worth of applications. And I'm talking, as the industry as a whole, right? We'll do about $1 trillion in a 6-month period. Well, we took in $1 trillion in a 3-day period. So as you can imagine,
Daniel, were these mortgage applications or refinances? Like, what were you seeing like the bulk of these like applications for?
it was 80-20, right? It was 80-20. I think there was 80% refinance. A lot of people just getting into better mortgages with lower rates, lower cost of funds. So there was definitely a big wave of refinance applications, but there was also a lot of purchase activity, right? I think a lot of people who have been kind of just waiting for that right moment, that right interest rate, made the leap and got lucky and locked in some of the lowest interest rates known to man. So, we're 45 days later now, right? We're in mid-April, and we've worked through that initial wave and through that initial tsunami because it kind of broke the system for a while. The system is not built
To get some
to
context,
handle.
as far
So
as, just to give a little context, as far as rates go, if you like, let's talk about Abraham Lincoln really quickly. So when Abraham Lincoln had a little cabin in Springfield, Missouri, Springfield, Illinois, and when he bought that cabin, he bought it at an interest rate of 6.5%. Is that correct?
yes.
Okay, great. Just so that's almost double the interest rate we have now. So it's very important to note that. Continue, Dan.
I mean, we can even talk about rates just in like the 70s and 80s when they were in the teens, right? I mean, my parents bought their first little house and were paying 13 or 14%, in the late 80s. But so we saw this tsunami of applications. The industry is not built to handle $1 trillion worth of mortgages in 3 days. It's just it kind of created this big bottleneck. But we're past that. I think what they did was for 3 days, rates were on sale, but it was like toilet paper. Everybody wanted it, and there wasn't enough. They disappeared overnight, and we saw those really, really low interest rates just disappear. Like on March 7th, 8th, 9th, they started going up. They literally went from like 3.25 to like 5% overnight. They did that intentionally to kind of throttle back the volume. They did that intentionally to slow down the application volume, and it was very effective. It was very, very effective. And so, 45 days later, we're now back in mid-April, and we're seeing that initial tsunami of applications work its way through the system. A lot of those loans are crossing the finish line, and now we're seeing rates come back down for the next tsunami of applications. And so, I think you throw in COVID in the middle of that. If you look at the calendar, COVID was actually starting to accelerate and really evolve in early March, right? And all the stay-at-home orders came in early to mid-March. And so, it was really interesting, having to shift everybody, to working from home. But the good news is that a lot of clients and a lot of people were able to take advantage of these really, really low rates. And there's this second wave coming that we're kind of getting ready for, because we're seeing the interest rates start coming back down from these elevated levels that we saw right after the initial drop.
Got it. So just a quick question, Daniel. Like, I don't have to pay my mortgage, right, for like the next 6 months. Like, I'm good. Is that right?
Yes, you're blessed in the name of the Father and good question, right? Lots of questions about forbearance, and I think there's a really important message about forbearance. There's a very, very important message that I want to convey to everybody, because I think what you read or see on social media or that quick article blurb that you see, online may not be telling the full story. And I think, look, unfortunately, so many people have been impacted by COVID, and it's created, the inability to make some of their obligations and mortgage payments and car payments and credit card payments. And, for those borrowers who have no other choice but to make or to request forbearance, then you should absolutely ask for a forbearance, right? If that is your last choice, if that's the last option you have, that's what the program is there for. It's for you to help you get through this tough time.
So
But what we're seeing,
forbearance, it's just to clarify, because I mean, some people may be on the call who don't know what this means, and so, forbearance isn't forgiveness, right? It's like, explain what it means. Like if I call my lender and I go, hey, look, I'm struggling with my mortgage. What are my options? Like, what are the options outside of forbearance? Like, what can I do? Like, how do I manage a situation? Because, I know some people that are really struggling, and need help. So like, what do you do? Like, what does it look like? You can't pay your mortgage. What do you do?
right? So, the government passed the CARES Act. Part of the CARES Act had this forbearance component to it, where banks could now allow borrowers and their clients and their borrowers to essentially skip a payment. But there's a couple of different things that are being done with those payments, right? And there's no one size fits all option for everybody across the board. They're doing a couple of different things with those, skipped payments. They're either tagging them to the back of the loan. So if you miss, 3 months of payments at $4,000 a month, well, they're going to take those $12,000 and they're going to put them at the back of the loan, right? That's one option. Another option that I've seen is that they'll take that $12,000 that you skipped or that you missed, and they'll say you have a balloon payment right when you start making your payments again on month 4 in this example. Then you have to pay back the $12,000 and start paying your regular mortgage payment again. Or I've seen that they amortize it over a period of time. So once you're back up and running and you're able to make your mortgage payment again, they'll take the $12,000 and maybe amortize it over the next year. So your payment might be slightly elevated for a period of time. So there isn't a one size fits all option for everybody. They're doing different things depending on your circumstances, but forbearance is really there to assist the struggling homeowner that has a legitimate hardship. And what I wanted to kind of convey is that unfortunately we're seeing a lot of people ask for forbearance that maybe don't really need it, right? Don't really need it. And, I've gotten calls from clients. I've gotten calls from family members, hey, Daniel, you're in mortgage. Should I ask for the forbearance? I can take a 12-month hiatus on my payment. What do you think? And I say, well, one of my uncles is a teacher. I said, you're a teacher, right? You're still getting paid? He's like, yeah, I'm still getting paid. I'm like, you have a lot of equity in your home, right? He's like, yeah, I've got a ton of equity. I'm like, I know you're a pretty good saver. You've got money in the bank, right? He's like, oh yeah, I've got plenty of money in the bank. He said, Uncle Fernie, your forbearance isn't for you. Forbearance is not for you, right? I said, because it'll have impact on your ability to potentially borrow in the future, right? Even though they're saying that your credit history may not be impacted, there's still other checks and balances that lenders and other finance companies do to check on your payment history, right? There's other documents and other checks and balances that are performed during the borrowing process. And if you request a forbearance, it absolutely can be a signal of weakness, right? And so the message is, ask for forbearance if you need it. If you have a true hardship, that's what the program is there for, to help you through that hard time. But it's not for that borrower who's just looking for a vacation from their mortgage payment, right? That's still working, that still can pay, that has money in the bank, and that has some savings. So I think it's important to know that it could prevent you from borrowing in the future.
Yeah, and who, like in the current climate right now, like I'm assuming, just based on my knowledge, like a lot of the programs that were out there have been kind of cut off. Like they don't do more riskier loans anymore. Like who's getting a loan right now? Who can get a loan?
That's a great question, Richard.
Yeah.
I'll describe today's lending mortgage environment as a plain vanilla loan world, right? We're operating and living in a plain vanilla loan world. And what we have seen is that there's been this suspension of all of the non-traditional mortgage products, right? There was a big return over the last 2, 3, 4 years. We saw this big return of these non-traditional mortgage products, such as bank statement loans, right? I don't know if any of the people on this call are maybe in the entertainment industry, but I do a lot of loans for people in the entertainment industry, people that are in production or talent, and maybe their tax returns don't document all of their income, but maybe they had great deposit history and their bank statements showed this excellent cash flow, and we had products for them, right? These bank statement loans. We had asset depletion loans where maybe a borrower, again, doesn't have great documented income on tax returns, but they've got a bank account with a healthy sum of liquid cash. Deplete that over a period of time and give that to them as qualifying income. Well, we've seen a complete suspension of all of those products. And we're in this plain vanilla loan world where you've got to have documented income. You have to have a strong credit score. And you have to have strong down payment. Now, what you're going to see is the tightening of the underwriting guidelines is going to be more prevalent and tighter on the jumbo space, right? So for all of you that may not know, that the jumbo loan amount starts at 766,000 essentially is the cutoff between conventional and jumbo. And so anything above 766 loan amount is going to have tighter underwriting guidelines.
And which
luckily,
probably bulk of loans in LA, probably in places like LA and New York, probably fall in jumbo. Would you say in jumbo territory?
Not as much as you think, Richard. I mean, we do actually see quite a bit of loan conforming space, people buying in that million range with sometimes 20-30% down, $1.1 million. I think the people buying in the super jumbo, like $1.2 million, $1.5 million, $2 million space, typically have 20% down, which is the new guideline. So the jumbo base, you no longer can buy a jumbo or buy a property with a jumbo loan that has less than 20% down. So they're still lending. We're still in business. We can still, get you financing. However, they're just tightening up the guidelines a bit on the jumbo space. On the conforming space, around everything 765 and below, the guidelines are still pretty flexible. You can still buy a home with 5% down and get a really awesome conventional loan. And the interest rates are actually going to be a little bit cheaper on the conventional side as well. So I think the message is that, if you've got some sort of, outlier in your profile with maybe income or credit or assets being kind of an outlier, it may be more challenging to obtain financing during this period. But, I think those products will come back once things stabilize.
Okay. Like for instance, me, like I'm probably like many people on the call, like, I'm self-employed, I'm an corp, I run my income through that. Like how do I prepare to get a loan in my situation? Is it just not doable for me right now, or how do I?
No, it's doable. I mean, I'm actually doing a couple of refinances for people that you and I both know, and so it's possible. A real estate agent can still get financing. Say that again?
Say their names.
Oh, sorry. No, we can't. It's private information, but yeah, I mean, we can still do loans for realtors. What we have to prove is that they're still working, right? And luckily, you guys have been all designated an essential service, and because you are, and so that's one good thing, right? You're designated as an essential service, and two, there's this extra layer. It's a great question because we're having to deal with this on a case-by-case basis. But the new underwriting guideline on every single file now is, can you please prove to us that you have not been impacted by COVID and you continue to work? That means something different for every industry. So for you, Richard, I'd say, hey, Richard, please provide us with a copy of, maybe a purchase contract or one of your in escrow files, right? And, you being as busy as you are and being one of the top agents in Los Angeles, you've always got several deals going at the same time, right? So it'd be very easy to provide financing for you. For a restaurant owner, they would need to provide a bank statement showing that they're continuing to, conduct business maybe through takeout orders or whatever. And as long as we see their business bank statements having some activity and some deposits, we can still lend to them. So I think each industry is, case by case basis, but still actively lending. The government wants us to continue lending. And so we're doing everything we can for every particular circumstance.
Awesome. And so, Lauren, I see some questions in the chat that I haven't. Is there anything there that we're missing or people want information on?
So really important one, BMW wants to know if they can take credit for introducing even Daniel.
Who's BMW?
Daniel?
I don't know who BMW is.
I don't know either. So I'm gonna go with yes. I'm gonna go with yes, he can.
BMW. Yes, she can totally take credit for introducing us. 100%.
So just some super important questions coming to me. Just rates is a main thing that people were concerned about and inquired about, was just general rates. So if you want to elaborate more on that, Daniel or Richard.
Sure. I have a question for Daniel that I think is, because I get this a lot, like the Fed dropped the rate to 0, and then people will call me and be like, it's 0, and so there's this like they're different, like, and so can you elaborate on that, Daniel, like what it means and how mortgage rates are tied to that, and yeah.
2:36 p.m. on March 15th. I'll never forget that day. I was at Osh in South Pasadena grabbing a generator. Yes, I was preparing for the zombie apocalypse, grabbing a generator. But 2:36 p.m., my phone starts blowing up. And I said, oh my God, what happened? Like, what's going on? And it was the announcement, Fed announcement. Rates are going down to 0, right? So everybody was like calling me saying, Daniel, we want to lock my mortgage in at 0%. I said, hold on, 20-second timeout. The Fed announcement has everything to do with home equity lines, variable mortgages, car loans, credit card interest rates. It has nothing to do with fixed mortgage interest rates. So the federal funds rate, again, controls all the things I just mentioned. It does not control 30-year fixed mortgages. So there's a big distinction there. So we had to educate, the public and our community, and, everybody in the mortgage world goes nuts every time, an announcement comes out. We're lowering interest rates or we're hiring interest rates. Everybody thinks it impacts mortgages, and it does not have a direct impact on mortgage interest rates. What does have a direct,
Sorry.
I was just going to say what does, because everybody wants, like, what should I follow? What should I be looking at? What should I, Google? And really the yield that has more of a direct impact on mortgage interest rates is the 10-year treasury. 10-year treasury is the yield that really dictates where mortgage rates are headed. And so if you look at the 10-year treasury, it's, rock bottom record lows. I mean, if you actually look at the math and the algorithm, where the 10-year is today, which is at about 60 to 70 basis points, it actually dictates that 30-year fixed mortgage rates should be at about 2.75%. Can you imagine a 30-year fixed at 2.75? It's probably coming. It's probably coming. So, to answer Lauren's question, or whoever asked the question, I think we're going to see interest rates remain low through the year. It's an election year, so like clockwork, rates always remain low through the elections. And we're probably going to see the lowest interest rates ever known to man, ever recorded. And I think that's kind of where the silver lining is that, if you're a buyer that's been beat up and, has been looking for a while or is not sure when they should make their move, one, buyers don't really have to compete as much right now, luckily. And two, they may be able to lock in some of the lowest interest rates ever. And so, I think it's we should probably, educate our clients, letting them know that there's a great opportunity opportunity, today that may be around after the election when interest rates will likely go up, because low rates are not sustainable, right? I mean, these rates in the twos and the low threes, they're not sustainable interest rates. They're artificially low to kind of stimulate and prop up our economy, and you can bet that they're very likely going to go up.
Yeah, I mean, what I'm seeing, like, and I'm on a lot of calls all day, talking to a lot of different people, and I think everyone's asking me, like, should I buy something now? Should I sell now? And it's like, it really is. It's a want versus need, right? It's like, I want to sell or I want to buy. Like, may not necessarily be the time to do that. You need to do it. Uh, you can do it, and it's really there. There is still demand out there. It's just logistically, how do we safely help people do this? It's safety is a huge factor, and I think. I mean, it may, I just feel like there's a division of, I'm going to go off on a small tangent here. There's a division of camps, right? You have people who take what's happening with this pandemic very seriously, and you have people who are sort of like, it's the flu, and I literally, right before I got on this call, a buddy of mine who lives in Washington, D.C., he got the invitation. He texted me and he goes, hey man, I can't get on the call. My aunt is in the hospital in the ICU on a ventilator and with a feeding tube. She has COVID. And it's like, it's a real thing, it's like, just because you can sort of maybe muscle through it and, you're healthy, it's like, it's the impact you have on other people, because we are all intricately connected. I mean, this is living proof. And I think as maybe independent Americans, and, we feel that we carve our own path. I said, but when something like this happens, you really understand the connection that we all have as human beings. Like, something like this spreads that quickly to everyone across the globe. So we're of the mind, like, if you need to do it, we can there's ways to virtually help do it as safely as we possibly can. But if you don't need to do it, probably wait. But I would, the caveat with that would be, and this is always like with clients, especially with buyers that we talk to, it's like, just be ready. Like, don't when it's time to move, don't spend that time getting ready to get ready. Like, be ready. Because I think when this passes, and hopefully it passes sooner rather than later, there is going to be this pent up energy across the board. Like, I lived in New York City, and I know when I would suffer through those winters, the first warm day in New York, it's just like, everyone's like, oh my God, and like, just people are out in droves. And it's like, I feel like that is going to happen in some degree. It'll probably pace into it a bit more with people who are a little bit more concerned, and will sort of ease into it. But I feel like there is going to be this pent up demand. Money's going to be super cheap, interest rates, as you were saying. And I think for home buyers, I would have themselves like prepared to take advantage of whatever's occurring in that period of time when things go back online. Because there could be good opportunities to be had at that time, and also to lock them in at really, really great rates. And then for sellers, I would say, just be ready, because what's going to happen is you're going to have, I think, of influx of buyers wanting to take advantage of cheap money. You're going to have limited inventory, which is going to drive pricing. So if you're a seller, you want to be ready to move into the market as things start to trend back up again. Because I think it's not what we're seeing is not a problem with the market. The market isn't broken. We have a health crisis, and so the market is a reflection of, the market is merely a reflection of people interacting together, exchanging goods and services. And so we have a physical distancing, which is sort of resulting in a financial distancing. But I think once that impediment is moved and we're all able to get out in the world again and be healthy, I think things will come back online pretty quickly. But yeah, just to reiterate, I think, determining whether you have a want or a need is super important right now, just to stay healthy. Lauren, I see more questions coming in.
Yeah, so we have a question here. How about phase 1 and phase 2 startup of the economy? How do you see that?
I think that there'll be a gradual, increase in rates as the economy can sustain it, right? As much as it can sustain it. Again, like I said earlier, I don't think these interest rates that we're seeing today are sustainable, right? I mean, they're there to do a job, And last time this happened in 07, 08, they did the exact same thing. And it was very effective. Lowering rates did the job that they were hoping for, that the Fed was hoping for. But they're not sustainable, right? Especially for our baby boomers who rely on, their savings and the interest and dividends they get from their money in the bank. These low rates really impact all of those people who have their life savings and are expecting a yield, a return on their savings. So I think that you're going to see a gradual uptick. I don't think we're going to see this overnight, rates go up from 3 to 4 to 5 to 6 all overnight. You're going to see this probably gradual increase as much as the economy can bear.
Yeah, and I think it's the same thing for people getting out into the market and interacting again. Like I said previously, I think it's going to be a comfort thing. Do I feel comfortable getting back out and engaging right now? I think it's going to be a gradual thing, but I think once it sort of gains momentum, the momentum will be back. I think, and this is, I think, the last thing I'll say, and we'll ask any more questions because we've already been on for 30 minutes, and I know people have things to do. Everything is cyclical, and the real estate industry is obviously cyclical. It tends to travel in a 10 to 12 year cycle, peak to bottom to peak. And so I started in real estate in Los Angeles in 2007, which is right when it started to collapse due to the subprime lending issue. And I got my license, and I'm like, hey, everyone's running the other way. I'm like, where's everyone going? And so I learned through the entire cycle. And so technically, based on the historical cycle, we should be sort of leveling off and sort of trending into a down cycle now, because we're 2007, we're about 2019. But what's really interesting is that we have this new, with the pandemic, with COVID, there's this variable that's been introduced into this sort of historic cycle, and it'll be interesting to see how this shakes out, just because no one's ever seen it before. So yeah, I think it's just a wait and see, but also be very ready. If you see something that is interesting for you, to be prepared to take advantage of it. So yeah, that's kind of, I think, it. Any more questions for Daniel?
Yeah, just Richard, I just want to make sure that everybody's specific question is covered. So we have one right here. Is there a point when low interest rates make your business model unsustainable, or high demands for loan dictates that you reduce supply? So like example, your lending rates.
Yeah, that's a very good question. A very complicated question to answer that I could probably spend an hour answering. But the short answer is no. Rates could go down to 2%, 1%, and it doesn't make the lending industry any more vulnerable or less vulnerable, because really the mortgage industry, where they make their money is on the servicing of the loan. And there's, give you the numbers, it's about 30 basis points, about, 0.33% of the loan balance that a mortgage servicer or a mortgage company gets for collecting the payments. And that's really where the money is. So the servicing value is where the mortgage companies make their money. And that's where that's not going to change, right? Whether the interest rate on the mortgage is 1% or 10%, they're going to get their servicing premium every year. So I don't, it's not going to affect the sustainability of the mortgage market. What the rate does, right? What the yield does, obviously, charging somebody 2% versus 8% on their mortgage, where it does have an impact is the investor who insures that loan, the investor who backs that loan. And on the conventional side, even, Fannie Mae, Freddie Mac are technically the insurers, right? You guys probably have all heard Fannie Mae, Freddie Mac. They're technically the insurers, but they don't have an endless amount of money and capital. What they do is they go to my 401k, they go to Richard's 401k, the teacher's pension fund, the firefighter's pension fund, and they use their money to insure and back these mortgage-backed securities. And so their spreads, their yield, their returns will be affected and impacted, right? Probably going to see a lower rate of return. But we won't, the mortgage industry will continue to lend, and it's not going to create any vulnerability for us. Great question though. I don't know who asked that question, but it was a really good question.
Lauren, anything else?
Does anybody have any other questions that I can answer? Happy to go into any other topic.
I had one. It'd be easier if I just say it. Is that okay?
Yeah, please.
So I was going to ask, it's kind of for both of you guys, but I can kind of think in my head of like scenarios of different, I guess, market forces that would make people want to buy a home right now or want to not buy a home right now. And like, obviously the interest rates are one of the biggest reasons to buy right now. Maybe will help get people who wouldn't normally do that to do it. But how are you guys seeing it play out? Like, are you getting, for example, loan applications that just sort of vanish eventually or like never materialize at a same rate as you used to? Are you seeing people who like are wanting to back out of sales because they want to stay where they are just because it's too risky to move at this point? Or, can you guys talk about that a little bit?
Sure. I mean, if you don't mind, I'll tackle some of that, and then Richard, I'd love to hear what what your feedback is as well. But on our side, we're actually seeing a pretty steady stream of pre-approval applications coming in, and I think it's because of what Richard spoke to earlier, and it's getting ready, right? I think people want to be in this ready position so that if and when that opportunity comes up, they can act, right? And so we are seeing actually a pretty steady stream of pre-approval activity and, people getting into escrow, believe it or not. I mean, and a lot of the listings, I'm having to compete. A lot of our buyers are going up against multiple offers. I mean, the last 4 or 5 purchase transactions, were all multiple offer situations. So, there certainly has been this like overwhelming sense of caution, and people are being a little more careful. I think buyers have a little bit of leverage right now, right? Because, of the uncertainty. The buyers, traditionally for the last 4, 5, 6 years, they've been beat up. They've had to go in there and compete and usually try to beat out 10, 15, 20. I've heard crazy stories, 80 offers on one property. So I think some buyers are just like, oh, great, this is kind of my time to shine. I've got the ball now. It's my game, my court. And we're actually seeing a pretty steady on the buy side. And on the listing side, Richard, I'd love to see what your opinion is on the listing side.
Yeah, I think what I'm seeing is people kind of want versus need. Like we were moving into a situation where we had several sellers coming to the market, and the ones that didn't need to sell have sort of paused for a minute to see how things are going to go. The ones that do need to sell, we're helping work through with them to make that happen successfully using all the virtual tools we have. But it really is. I think you're right. I think there's a buyer opportunity that will present itself in the next 6 months. And I think it's just about being ready. And we have lots of buyers who are in the process of getting ready, and I think they'll be able to take care of that opportunity. But I think what will happen is the influx of buyers pushing into the market, the limited supply of homes for sale will then start to escalate the prices again. And then sellers will start to move back into the market again. So that's what I think will happen. Yeah. Anything else, Lauren?
No, Richard, I think everything was covered between the two of you guys.
Okay, awesome. Well, we're going to wrap it up. I want to thank everybody for being on the call today. Hopefully there was some value there. And like we talked about a little bit earlier, I don't know if everyone was on the call, this ongoing conversation is not going to be just real estate and just finances and just mortgage. We're going to cover a lot of different things. Next week, we're gonna have a really great guy who I've known for 12 years. Our kids went to preschool together. Most of you may not know this, and I'll share with you guys. So I suffer from anxiety, and so I've probably struggled with that for a very long time as an adult, and recently have been able to really sort of make some strides with that and really sort of impact my life in a really positive way. And the gentleman who's going to be on the call next week has really helped me with that. He is a licensed marriage and family therapist. He's been in private practice with individuals and couples for over 15 years. His name is Aaron Buckwalter. He's a wonderful guy, and he's going to come on next week and talk about practical ways to appreciate the good effects of what could be happening now, but to also address the challenges of dealing with the unknown. which is what we're all dealing with right now. You'll have an opportunity to ask questions. You can send in questions, we want to have an open dialogue with it. So whatever your comfort level is, feel free to engage. But I think there'll be a lot of valuable information out of that. I know, like, personally, like my wife asks me all the time, when is this going to end? Is this ever going to end? Are we going to go back to normal? What's the new normal? Or maybe I don't really want to go back to the normal that I had before. A lot of stuff has come up, I think, for a lot of people, and you may be in a situation where you feel a bit sort of isolated, even though you may be with family and doing the daily task. You may not have the ability to engage and sort of process through what you may be feeling. So we want to open up that. So hopefully you can make it back next week, and I'm sure it'll be a great conversation with Aaron Buckwalter. And once again, thank you guys so much for making the time to be here. I know you're crazy busy with your life and trying to stay safe and trying to stay healthy. But thanks so much. I really appreciate it. Have a wonderful day and have a wonderful weekend. And we'll talk to you guys next Friday at 12:30. Bye.
Thanks, guys. Be safe.
Oh, thanks, Daniel. Sorry. Thank you to Daniel. We appreciate it, man. Thanks for making the time.
My pleasure. Take care, guys.
Yes.